Most traders think that a fair value gap is an entry when it's really not. Let me show you why. When it comes to trading candlestick wicks, I want you to think of it as if you are driving a car. If you have a candlestick wick on top of a body, I want you to think of it as your windshield. And if you have a candlestick wick below the body of a candle, I want you to think of it as your rear view and side view mirrors. And what the wick allows us to understand is how well or bad are the conditions of the road ahead. So taking a look at this chart pattern here, we see prices moving up, meaning we are driving forward. And we have a candlestick on top of this candle body telling us that we are looking through our windshield. And the longer we have a wick on top of the body, the worse the conditions of the road are. Whether that be the road is destroyed, there's major construction going on, or whatever you want to think of it, the longer the wick, the worse the conditions of the road. And taking a look at this wick tells us that the conditions of the road up ahead are bad, because what this tells us is that there is strong price rejection. And I hope if you saw that the conditions of the road up ahead were horrible, you would not drive there, because if we expected price to go up, it would only probably have a 20% chance of actually going back up. Rather, it would be easier for price to fall down because we have no lower wick telling us the path is clear down here, which would have a higher likelihood of heading down, being around 80%. And if we take a look at this example down here, our lower wicks, which means we are looking through our rear view and side view mirrors, tells us that the condition of the road behind us is not so great. And that is because we have long lower wicks telling us that there is a rejection of lower prices. And because we have no upper wick, this tells us that the conditions of the road are excellent and price is likely to head higher with around an 80% chance of increasing, while if we expected price to continue lower, it would have only maybe a 20% chance of going down. And this is all coming from my Trade Like Dre University PowerPoint that I created for you guys. So if you're ready to take control of your day trading, go ahead and check that out. But nonetheless, let's take a look at when it comes to fair value gaps. Notice we have a move up, we create our fair value gap, and we have a pullback into that fair value gap with long lower wicks on the bottom of these candles, telling us that looking through our rear view and side view mirrors, the road is not well conditioned. Therefore, there is a higher likelihood that price continues up. And that is a trade we want to take at the first candle to make a new high, anticipating price to continue its trajectory up. We want to trade the reaction and not the gap itself. So I really hope you guys were able to take something away from this video, and don't forget to check out Trade Like Dre University. And with that being said, I'm gonna catch you guys on the next one. Dre is out.